At the age of 8, I learned to play the game of golf. And throughout my teenage years, I had the pleasure of playing golf with the president of the Rotary Club, the treasurer of our church, a town councilman, the mayor of our town, the vice president and chief financial officer of a metal manufacturing company, or as I like to refer to all those gentlemen as Dad. From a very early age, although I don't recall ever having a discussion about it, I learned through his example that my dad felt it very important to give back to his community. And so today we're going to talk about a topic that is very near and dear to my heart, about turning our concern into meaningful action through thoughtful planning. Now, throughout today's strategies, today's presentation, we'll be talking about different strategies that do have different tax consequences and benefits to you. And we do encourage you to work with your tax and legal advisor on implementing strategies that may be appropriate. Hammond, Iles Wealth Advisors does not provide tax or legal guidance, but we do provide financial guidance through recommended strategies that then these professionals can help you implement. And there are lots of strategies out there. We'll touch on a few today, but each can be molded to your specific situation. And so I hope that today you take away on how you can implement some of those. Now, as we look around the world, we see many different headlines like these that pop up. These are just from the last 12 months, let alone the last few days, that more headlines continue to bombard us. And many of us feel concerned about what is happening around us and those individuals around us. But concern itself rarely creates any change to address those challenges. It's really only through thoughtful and meaningful action that change occurs. And so today we're going to talk about how thoughtful planning turns that concern into meaningful action. And through thoughtful planning, we mean a practical approach to supporting the people, causes, and organizations that you care about. Now, the challenge that we face in starting to think about kind of meaningful action is what we call the giving paradox. On one side, we have the fact that concern is high, that there are many needs that are visible, and that we want to help in some form or fashion. But the paradox to that is, where should I give? How much should I give? And will this affect my financial plan? And so the challenge is that the desire to help is strong, yet the clarity about how to act is missing. And this reminds me of when we see a lion tamer. You don't see them that often, very often, but the typical image, like we see here on the screen, is that a lion tamer holds out a stool towards the lion. And I don't know if you are familiar with lion taming, maybe a side hobby or interest, but the reason why a tamer usually holds up a chair or a stool towards the lion is because what the lion sees coming at him or her is the four legs or ends of the stool. And so the lion doesn't know which of these four legs it should focus on. And so as a result of that, it freezes in place. And so when we think about taking meaningful action, the same holds true for us as humans. When we're bombarded by headlines and needs everywhere, it can become overwhelming that we get to the point that we freeze and we don't know where to focus our action. So today we're going to provide you with a framework to help with that, to be able to focus your action in a new way of thinking about it. It's through a more thoughtful approach, because what we tend to have with our giving is a more reactive giving, whether it's the ad on the television or that we see online or the solicitation we receive in the mail or the person outside the grocery store that's asking us for a donation. It's all driven by emotion. It tends to be sporadic as we are asked. It can be stressful, and that when we're reaching into our wallet or handing over our credit card, or we have this ability that we don't know how this will impact our financial picture. And so it tends to be unknown. We don't know what the impact will be, who we're benefiting in many cases, or what that dollar or several dollars or thousands of dollars will be used for. So today's conversation is to turn that from being a reactive giver into a more thoughtful giver. First is how do we take the time to think about our values and what we want to honestly support with our giving to make a greater impact, how we can be more intentional about our giving rather than it just be on a sporadic basis when something pops up. Also, it's integrated into our financial plan, so that's planned giving that we know we can afford and can be sustainable within our financial plan. So to start off with that, we need to focus on what we can control. We can't control the many asks and solicitations that come our way. Although we can unsubscribe, we can kind of just send them off to the recycling bin or the trash. But we can focus on these four levels. We can focus on who do we give to, how much we give, and how you give, and when you give it. These are four things that we'll talk about today that we need to take time to think about and examine to be a more thoughtful giver. So how do we go about aligning our giving with our values? Well, the one thing that I would recommend in one exercise is a news review. It's one of the activities that I talk about in my book, You Can Do More That Matters. Normally in the book, when I wrote it, a lot of times we talk about grabbing the Sunday paper or the daily paper, although a lot of our news that we consume these days are no longer in paper form. So whether it's your newspaper that you receive on the weekends or it's your online news feed that you have, I encourage you to take out a notebook. And on that notebook, draw a line and divide it into thirds. And so what you want to think about are three things, and make notes as either you go through your news for the day or for the week. And in the first column, think about the things that you see, the headlines and the articles you read that make you sad. The second is to write down the list of things that make you angry. And the last is the things that bring you joy, that you are happy to see and support. Because when it comes to turning concern into meaningful action, it requires us to have some emotion with that. And two of the most powerful emotions that we have is love and hate. Two sides of a coin that we can see different issues. And by noting them on our notepad as we go through our week or our day in our news feed, we will start to see some trends evolve on what you value as things that make you upset and angry, that you hate, and things that you want to support that bring you joy. You'll start to see those trends. And it's important to realize also that there are two sides of everything that you put on this paper. So, for example, I love my dad, a mentor to me, but I hate and I'm angry about the blood cancer that took him away from me 10 years ago. So, how do I turn my feelings about that to support? And it's one of the reasons why I dedicate time, effort, and money to supporting blood cancer research and support for families dealing with blood cancer. So, by looking at the things that are in the news that impact us, both either from what we love and support or what we hate. We love pets, whether it's dogs or cats, but we hate the fact that they get abused by some people. So how can we look at these two sides of the issues that can provide us a glimpse of the values and the way that we want to make meaningful action and impact? Because when we integrate our generosity into our financial plan, it's important to not only follow our values, but understand that our giving should not compete with our financial goals. And that's partly why it's important that we're going to talk about kind of the challenges that we have and the opportunities that we have, because we want to not make this just a one-time giving opportunity. We want it to remain sustainable and consistent over time, and that it fits comfortably within your financial plan. Now, there is this giving opportunity. As I mentioned at the beginning, there is no shortage of opportunities to support different causes, organizations, and the people in our lives. But the opportunity we have to look at in a different way. Many of us think about our wealth as a pie. And if I carve off a piece and hand it over to charity, or I gift it to a family member, what immediately occurs to me is that my pie just got smaller. However, it's important to understand that through thoughtful planning, we can actually make our pie bigger, that we can end up making an impact on the causes and organizations we care about, as well as the people in our lives, and continue to take care of our own financial needs through our financial plan. But the challenge when we start thinking about giving is most gifts are given through the checkbook or on a credit card. We immediately think of cash when it comes time to give. However, when we take a look at the average American household financial wealth, what we see is that really of our financial assets outside of our home and businesses and our cars and other personal items, our financial wealth, only 14% of it on average actually exists in cash and bank deposits. Yet, that small part of our overall wealth pie is where we immediately go to when we're asked to give. So today, as part of our thoughtful planning, I want you to start thinking about the rest of your financial wealth. The part through taxable investments or in your retirement accounts, and how those assets can be used not only for giving, but then also giving you some additional benefits that make your pie bigger. So to start off, let's talk about that part of taxable investments, about the possibility of donating appreciated investments. I'd like to introduce you to Sue and Matt. Sue and Matt are early in their careers by some of our standards, age 40 and 37. They're both working. They started investing right after college, and they annually support their alma maters as well as some other nonprofits. And as I described, their first instinct is to immediately donate through cash or writing a check or using their credit card. However, we can take a look at donating appreciated investments. And this doesn't just apply to individuals in their late 30s, early 40s. This applies to all of us. We all can take a look at donating appreciated investments. It's an opportunity where we can give once and save twice. So how do we go about donating an appreciated investment, and what does that look like? So let me show you an example. So for Sue and Matt, they purchased an exchange-traded fund or an ETF, and it doesn't have to be an exchange-traded fund. It can be a stock, a bond, a mutual fund, any type of appreciated investment. And they purchased this back in 2015, and they invested $20,000 back then. And if we fast forward to this year, the value of that investment is $45,000. So when we take a look at that, they have an unrealized capital gain of $25,000. So if they decided to go buy a new car or to buy a house or to use these funds for any personal use, they would need to sell the investment, and then they would pay capital gains tax on that $25,000 of appreciation. However, if they donate that ETF, whether it's all of it or part of it, they have the opportunity to avoid that capital gain. So first of all, they get a full tax deduction equal to the market value of the investment. So in this example, if they donated the full investment, they would get a charitable deduction for the full $45,000. Even though they only paid $20,000 for it, they get the full market value as long as they've held the investment for over a year. The second is they have that second opportunity to save, is that there's no capital gains tax. When you give an appreciated investment to a nonprofit organization, they're able to sell that investment with no tax consequences. So the taxes that you would have recognized are not there. Now, you may say to me, Greg, I love this investment. I don't want to give it up. Well, then what I would recommend doing is donate the investment with the appreciation, and then use the cash that you were intending to give to the organization and buy the investment back. So in this example, if I had $45,000 in a savings account, I could turn around and buy that same exchange traded fund back. So at the end of this, I still have the exact same investment. However, by doing that, I've donated away the unrealized capital appreciation, and now my cost basis in that investment is now $45,000. So the net effect ends up being the same if I want to keep the investment. Otherwise, you can just carve off a piece or give away the investment. And also, if you donate the appreciated investment into a charitable fund, which we'll talk about in just a little bit, you have the opportunity to diversify outside of that investment without the tax consequences as well. So it's important as we think about giving that we think about donating appreciated investments. A second tax advantage way of making donations is to think about how we record those donations and our deductions on our tax return. It's what we call bunching, where we take donations over different periods of time and put them together to get a bigger benefit. And so here is Mike and Barbara. Mike and Barbara are both age 62. They're both still working. They have no debt, and they annually support their church and other nonprofit organizations. And so as we talked about their giving, we wanted to talk about bunching. Now, for many individuals, the tax aspect of giving is becoming less and less an incentive because of higher standard deductions. As part of the Tax Act passed in 2017, the amount of standard deductions was increased substantially, and then that was made permanent in the One Big Beautiful Bill that was passed in 2025. For 2025, that standard deduction for a married couple was increased to $31,500. Now, if you have individual, if you are over the age of 65, there are an additional deduction. There's a new seniors deduction between 2025 and 2028. But for this conversation, I'm in for Mike and Barbara. They're under the age of 65, so we're focusing just on the joint standard deduction. And if you're single or head of household, you also had a substantial increase in your standard deduction. So let's take a quick look of what that looks like, because for most people, almost 3/4 of households, 3 out of 4, use the standard deduction. However, through thoughtful planning, we can bunch items together to take advantage of that, because every year you can make a decision: do I itemize my deductions or do I use the standard deduction? You can go back and forth from year to year. Now, when we take a look at Mike and Barbara, because their house is paid off, they don't have much in the way of deductions. Their deductions primarily fall into 2 categories. One is that they pay property taxes on their home, which are $14,000 a year, so they pay $7,000 semi-annually. And they also make about $10,000 a year in charitable donations. Now, when we take a look at that, so their total itemized deductions for 2025 is $24,000. It's the property tax plus the charitable donations. Now, as we looked at the previous slide, their standard deduction is $31,500. So they have been always just looking at taking the standard deduction. However, we can do some thoughtful planning. How do we do some planning to bunch their itemized deductions to take advantage of their deductions in a single year as opposed to multiple years? So how do we go about doing that? Well, the first easy one is that payment that they normally pay in property tax in January. Let's back that up and just pay it on December 30th or 29th or sometime just before the end of the year, so that that deduction becomes part of the prior year. So now we have 3 payments in 2025, or if you're looking ahead at your planning for this year, in 2026. And then also we're going to take a look at using a strategy, using a donor advised fund on basically taking 3 years worth of charitable donations and consolidating it into 1 year. So making one donation to a donor advised fund, which then will get paid out over 3 years, but it allows us to take the deduction in a single year. So now when we take a look at this picture, our total itemized deductions for Mike and Barbara are now $51,000. So now this year, for 2025, we can take the $51,000 in deductions. But even though we've shifted everything back into 1 year, then in the next 2 years, we just opt to take the standard deduction. So rather than just having standard deduction, standard deduction, standard deduction, we've itemized to get a higher amount in 1 year and then use standard deductions in the subsequent years to get more deductions than kind of skating underneath that standard deduction level. So in this example, I talked about using a donor advised fund. And so when we take a look at the donor advised fund, the fun thing is that you get to name it whatever you want to call it. And so they called it the Jones Amazing Impact Fund, which is kind of fun with it. And as I mentioned in the example, they typically donate $10,000 per year, but we're going to instead kind of front load that with $30,000. Now, certainly they could pay that out of cash, but as we already learned today, cash isn't always the best place to take a donation from. So learning from Sue and Matt, they said, hey, let's take some of our appreciated investments and donate those into the impact fund. which the impact fund can then sell that investment and diversify the portfolio within the fund. Now, each year, what they can do is then they send a grant request to the donor advised fund, which then pays out that money out to the charity or charities of their choice. And they can choose when they make those donations and even if they make those donations. Another example that I'll share is a client of ours that sold their business. They had a large capital gain in selling their business. And so in that year, they took some of the proceeds from the business being sold and they put it into a donor advised fund. So they front loaded the donor advised fund to offset the capital gains from selling the business. And then they have the opportunity to donate those funds out when they choose. But for the purpose of tax purposes, you get the deduction. Let me say, you get the deduction for the donor advised fund in the year that you make the donation. So you get to claim that larger charitable deduction in a single year, and then you can use the standard deduction in the following years. Now, one of the things that you may be dealing with this time of year is when you do make charitable donations, you have to search around for those donation confirmation letters to document your gifts. So rather than having to look for multiple organizations, when you donate to a donor advised fund, you just have one letter. You have one letter from the donor advised fund on the gifts that you made this year. And you can do it in multiple gifts. It doesn't have to be a single gift, but it's still just one donation. So it simplifies that. And as I mentioned, if you're donating appreciated investments, you avoid the capital gains on it. Now, inside the donor advised fund, donors can have the opportunity to control the investments since they aren't required to be paid out at any time. The balance can stay in the donor advised fund and actually grow over time based on the underlying investments within the fund. And they can pay out to multiple organizations and causes. You're not tied into any individual organization. So while we're talking about tax advantage giving as part of our thoughtful planning process, we also want to talk about qualified charitable distributions, the opportunity to give donations directly out of that biggest part of the pie, that retirement account, whether it's an IRA or an employer retirement account. Actually, employer retirement account doesn't apply for this, so this only applies if it's an IRA. And in this example, we're talking about Jim and Joan. Jim is 73, so he just reached the age of having to take out required minimum distributions. Joan is not quite there yet. They're both retired, and at this point, they don't need Jim's required minimum distribution for living expenses. And they support various nonprofits annually. And so when they looked at that pie chart of, well, where can we take money to make our gifts, rather than thinking cash all the time, we talked about looking at their retirement accounts. So in this example, we talked about a charitable distribution from their IRA, which is a qualified charitable distribution or a QCD. Now, to qualify, you have to be at least age 70 and a half or older. And for 2026, you can gift up to $111,000 out from an IRA directly to a 501c3 charity. That annual limit goes up and is adjusted for inflation, so we can give out a lot of money over time. And the benefit is that when the qualified charitable distribution comes out of the IRA, like it would normally be taxable to you when you take the money out, by giving it to charity, it's not reported as taxable income. Now, on the flip side of that, you don't get the charitable deduction if you're itemizing, but if you are using the standard deduction and not getting a benefit from your charitable giving anyways, a QCD is a great way to reduce your taxable income. Now, as an extra benefit for Jim, since he's now 73, is that the QCD also counts towards his required minimum distribution. Required minimum distributions kick in because Uncle Sam is tired of waiting for that taxable income to come out. And this is one way to kind of cut Uncle Sam out of the picture. We can give money directly to charity. It's not reportable as income, and so it's not taxable. And that avoids federal taxes. And if you happen to live in a state or local city that has its own tax consequences, it can also avoid taxes in those jurisdictions. Because many states, like here in the state of Connecticut, we use our adjusted gross income from the federal tax return to calculate our state tax. So by the amount being exempted from federal tax, it lowers our adjusted gross income, which then lowers our state tax as well. Now, there also is a special exception that you get a one-time donation of donating up to $55,000 to what's called a split interest entity. And we'll talk a little bit about these, either a charitable remainder trust or a CRT, or a charitable gift annuity, a CGA. I should have probably sent you a glossary before this so you'd have all of these abbreviations, but please know that this will be recorded and you can always refer back to it or just reach out to our office. Now, one of the things we just previously talked about, a donor advised fund. Although a donor advised fund is typically held at a foundation or a nonprofit organization, you cannot pay that money from an IRA out to a donor advised fund. So we can't mix and match here on these two strategies. Also, as I mentioned, a qualified charitable distribution has to come out of your IRA. If you have a 401k, 403b, 457 plan, or some other type of employer retirement account, you can't make a qualified charitable distribution directly from that account. You would need to roll over funds from that account into an IRA, and then from the IRA pay it out to the charity. And when you do so, there's no tax. So in Jim's case, we made a $5,000 qualified charitable distribution. It resulted in no tax on that $5,000, and while it also satisfied part of his required minimum distribution. So again, it doesn't have to be all of your minimum distribution. It can be all of your minimum distribution if you want to completely give it away, as well as you can give away more than your minimum distribution. The minimum distribution is just that, is just a minimum. You can always distribute or take more out. So we talked a little bit about those split interest opportunities, and that's where strategic gifting can come into play to create more retirement income. Now, I bet coming to this workshop, you didn't think, hey, I could get a pay raise through my thoughtful planning. And it's true, you can create more retirement income for yourself and your spouse and your family through charitable planning. So how do we go about doing that? Well, let's talk about Scott and Cindy. They are ages 75 and 73. They're both retired. And although they live comfortably on their current income, having a little extra would be nice, either to take an extra trip or spoil the grandkids a little bit more. However they choose, they would like a little bit extra for those extras. And they would like to support a charitable organization that they care about. So how do we do some thoughtful planning to make this meaningful action to accomplish both? Well, one strategy is using what is called a charitable gift annuity. And so a charitable gift annuity is set up typically through a foundation or through a nonprofit organization. And the way that it works is that you fund it either through cash or ideally appreciated investments. In exchange, the annuity pays you and your spouse or family member an income over your lifetime. And then when you eventually pass away, whatever's remaining in the annuity passes on to the organization that you have the annuity with. So how does this look like for Scott and Cindy? Well, the other benefits of making a gift to a charitable gift annuity is that they get a charitable deduction at the time that it goes in. It's not for the full amount, and I'll go through an example just so you can kind of get a sense of what that looks like. Also, they get to defer any capital gains. So if they're donating appreciated investments, it helps reduce the tax consequences on that. And some of it comes out tax-free, so it's tax-advantaged income for their lifetime. And if they have an estate large enough that it's subject to estate tax, it can help reduce the size of their taxable estate. So let's talk about an example for Scott and Cindy. In their case, they had a stock worth $50,000 that they originally purchased for $20,000. So they have unrealized capital gains there of about $30,000. And so they donate that stock into the charitable gift annuity. Now, based on their ages, they will receive $3,000 a year, which is 6% of the amount that they put in for their lifetime. An extra $3,000 a year, with $776 of that coming back to them tax-free every year. Now, out of that, they will pay some tax. On $1,059 will be taxed as ordinary income. $1,165 will be taxed as long-term capital gains for them. So that will have the lower tax rate of a capital gain as opposed to ordinary income. And based on the current interest rate for the federal government, the charitable deduction that they'll receive on donating that $50,000 of stock is $16,611. And it's estimated that in addition to receiving income over their lifetimes, that it's estimated that the charity will receive around $25,000 at the end of the rainbow. So they get the benefit of the tax benefit, they get the income, which is tax advantaged, and they make an impact on an organization that they care about. Kind of checking all the boxes with one gift. Now, if you're interested in learning more about kind of what a charitable gift annuity looks like, you can certainly ask the organization that you want to support whether they offer charitable gift annuities, and they can run an illustration or a quote for you. Also, there is an organization called the American, I always forget the abbreviation, another abbreviation here. It's the American Council on Gift Annuities. There we go. Just had to wait for that Ferris wheel in my mind to come right around. The American Council of Gift Annuities, although they don't offer gift annuities themselves, they set, based on current interest rates, kind of what they recommend organizations set as distribution rates at different ages. So for example, if you're single, age 65, currently they're saying that the distribution rate ideally would be around 5.7%. At 75, it would be around 7%. And if you're a married couple where the income would be over your joint life expectancy, the rates are a little bit lower because it's based on 2 lifetimes, and that those rates are around 5 and 6.2. Now, they do have it by year. Also, if you are a couple like Scott and Cindy here that are different, have a difference in ages, they also have a table that you can take a look at that based on your ages. So you can find them online if you search ACGA or just search out charitable gift annuities. Now, a second way of setting up a lifetime income is that you have a charitable remainder trust. Now, this is a little bit more complicated because just like a revocable living trust or any other type of trust, it does involve writing a legal trust agreement. So it would involve an attorney, so you would have attorney's fees involved with that. But with a charitable remainder trust, it works very similar. That you fund the charitable remainder trust, it pays income out to you on an annual basis, and then the remainder passes on to either a charity or multiple charities. One advantage of writing a charitable remainder trust is that you have a little bit more flexibility in creating the trust agreement based on your needs. So, for example, you get to determine kind of what that distribution rate would like to be. It can be either a set amount, for example, 5% of the amount that you contribute to a charitable remainder trust. So, for example, if you put $200,000 in, it's going to pay you $10,000 a year coming out. Some trusts are structured that the percentage is 5%, but that the amount adjusts based on the value of the trust, so that as it's invested inside the trust and it grows in value, your income could potentially grow over time. But at the same time, if the balance goes down, it'll scale back your distributions based on the value of the account. So you have a lot of flexibility. But again, you get to receive lifetime income. You do get a charitable deduction, and it is calculated. It's not the full amount that goes into the charitable remainder trust. However, one of the things with a charitable remainder trust is it is considered a separate charitable entity. And so because of that, you completely avoid the capital gains taxes on any appreciated investments that you put into the charitable remainder trust. And again, it's outside of your estate. It's a completed gift. So once you give to the charitable remainder trust, it's in there. So it reduces a taxable estate if you are lucky enough to have a taxable estate. Just to take a pause, I see one question that came into the chat. What can I do with the money I put in a qualified charitable distribution? So it's a good question. So a qualified charitable distribution is not an account. It's a distribution from your IRA. So you're not investing it inside a qualified charitable distribution. It's just a process of paying it out of your IRA. And rather than coming to you as the account owner, it's going directly to a nonprofit organization. It has to be a 501c3, and it can be to multiple organizations. So you can pay those amounts out. It depends on the custodian of your IRA. At Hammond, Iles, we use Charles Schwab as the custodian for our investment accounts. And I believe for them, there is a minimum check amount of $500. But other than that, we can pay money out to organizations any amount above that. So you're not using that qualified charitable distribution to invest. The only thing where you could potentially put it to invest is that one-time lifetime exception, where you have the ability to put up to $55,000 into either this charitable remainder trust that we just talked about, or like the previous example, in a charitable gift annuity. In that example, a charitable gift annuity, typically the investment inside of it is managed by the nonprofit organization offering the charitable gift annuity. With a charitable remainder trust, the investment within the trust remains under your control as the donor to and grantor of the charitable remainder trust. So I hope that answers your question. If you have any others, please feel free to add them into the chat. I know that we have covered a lot of ground and a lot of information in a very short period of time. So if you do think of a question after today's workshop, you can email it to us at hello@hiwealth.com or reach out to our office. Now, when it comes to thoughtful planning, one of the things that I talked about at the beginning is that we also want our thoughtful giving to be sustainable and to be incorporated into our financial plan. And based on your circumstances, that may not always be possible. Some individuals have saved enough for their own retirement, but depending on how long they live and inflation, they're a little concerned about giving out more now. And it's similar to being on a plane. If you recall, the message that gets shared every time is that make sure if there is an emergency and the oxygen masks come down from the ceiling, you want to put your own mask on before you help others. And the same holds true with thoughtful giving. We need to make sure that we have a financial plan in place so that you are taken care of before we look at helping others. We don't want to jeopardize your plan by giving out too much too early or giving out more than your plan can accommodate. So it's important to have that planning, but there are options available that we can plan to give later. So I'd like to introduce you to Anne. Now, Anne, we did some legacy planning. Anne is age 75. She's retired. She needs her required minimum distributions for her own living expenses, but she wants to give more, but is concerned about not having enough for her lifetime. So we took a look at a couple of options that could work for Anne in making an impact that allows her to plan now and give later. So the first is that she can name charities in her will, or if she has a revocable trust, including charitable organizations in that trust document. So as part of her estate plan, she can incorporate charities. So after she's gone, part of her estate then gets paid to the organization or multiple organizations that she cares about. Another way to do planning for the future that doesn't necessarily involve the cost of an attorney or adopting your legal agreements is to name a charity or charities as beneficiaries on an IRA or an employer retirement account. Now, your last will and testament will not have any impact on your retirement accounts. Those are all directed based on your beneficiary designations, and which, by the way, that will be our presentation next month on the do's and don'ts of designating beneficiaries. But you can, with just the submission of a new change of beneficiary form, add a charitable organization as the beneficiary of a retirement account. Now, if you're married, you can still keep your spouse as the primary beneficiary, but you can name a charity or multiple charities as the contingent beneficiaries if something happened to both of you. Or if you're a surviving spouse or single, you can name organizations as a beneficiary. Now, one of the things I would like to highlight is that you don't want to leave Roth IRAs to charity, although you could. But because the money comes out of Roth IRAs tax-free, it makes sense to leave those to family members that can enjoy the benefit of the tax-free amount coming out to them rather than a taxable IRA or employer retirement account. So an easy way to include a charitable organization in your planning is just to add them as a beneficiary. And as a caveat and a little teaser for next month, I would encourage you, if you add a charity, if you want to have family members on there as well, that you break them apart. They have a separate IRA just for the charitable beneficiaries as opposed to combining living people with organizations. We'll get to more details next month. So as we start to look at wrapping up today's conversation, I want to share some of the key takeaways with you. First is that concern is natural. We as humans are going to be empathetic and have lots of concern for those around us. And the key here is we don't need to solve everything. Even though we may have a desire to try to solve everything, we can't. So we need to focus on what we can control financially. And that is making sure that we go through a thoughtful planning process, taking a look at how we align our giving with our values and how we do it in a thoughtful manner that is incorporated in our financial plan rather than disrupting it. And always, always understand that small intentional actions matter. Don't feel that you have to be the next billionaire to accept the challenge to make it a world a better place. We all can take steps through thoughtful giving to make an impact. So when we think about the challenges that we face, there are lots of them around us. There's no shortage of the challenges that we could make an impact on. The importance is, how do we focus our efforts so that through thoughtful planning, we create meaningful action that's sustainable, confident, and that we have that meaningful impact from it. We want to be able to sustain it for the future, that it's not just a one-time off giving, that it's sustainable, and that we are able to have that not only support us through our lifetime, but hopefully maybe even impact those beyond our lives. So although there are many challenges, it's through thoughtful generosity that allows us to move from concern to meaningful action. So you may be sitting there, and here are some of the common questions that people ask. How much can I give without affecting my retirement? Should I give from my IRA or appreciated investments? Which of those additional buckets outside of cash makes sense for me? Is a donor advised fund right for me? And how do I support multiple causes and organizations rather than just being committed to one? If one of these questions or other questions are top of mind, I encourage you to reach out to us. Because what would meaningful action look like for you? Well, it's starting with a conversation. And if you're a client of Hammond Iles Wealth Advisors, you can reach out to our office and we'll schedule a meeting where we can start the conversation of what meaningful action might look for you. If you're not a client of Hammond Iles, or you're watching this video on YouTube or some other location, we offer a free conversation with a financial coach, either by scanning the QR code on the screen now or by going to our website at hiwealth.com. And we encourage you, if you'd like to refresh and go through these examples again, you'll find this recording on our YouTube channel. And additional resources around thoughtful planning are available through our social media as well as on our Hammond Iles website. So I encourage you to reach out to us to start the ball rolling on your meaningful action. You can call us, email us. If you have questions specific to you that you'd like answered, you can email us at hello@hiwealth.com. And reach out to us through our website. We have offices in Connecticut, Vermont, and Virginia, as well as work with clients in over 30 states online. So with that, I really greatly appreciate you taking time out of your day. I hope that this has been a conversation that has caused you to stop and think about your giving.